Hello everyone, this is Yuvraj, working as an assistant professor in Department of Commerce and DM at Dr. SNS Rajashmi College of Arts and Science, Coimbatore. Now today we are going to see about the topic of banking analysis. So what does mean banking analysis? It is nothing but it is a key financial assessment for bank performance and risk management. These are the banking analysis. So introduction. Financial analysis of banks evaluates stability, profitability, and reliance against shocks. Focus is on capital, liquidity, and asset liquidity to ensure sound operations. This overview sets the framework for assessing capital adequacy and assets quality across core banking activities. Number one, we're going to see about risk assessment. So what does mean risk assessment? So credit risk, assess probability of borrower default and loss severity. Monitor NPL ratio, provisions coverage, and exposure concentration to measure credit quality. Evaluate portfolio segmentation, correlate effectiveness and credit loss terms to guide provision and underwriting adjustment. So next is then market risk. So what is mean market risk? Market risk arises from interest rate, FX and price movements. Measure using VAR and stress tests alongside duration gap analysis for interest sensitivity. Monitor trading exposure, liquidity buffers and hedging effectiveness to limit mark-to-market losses and funding strain is an market risk. So next now we are going to see about operational risks. So what are the operational risks? It is nothing but identify process failure, fraud and systems outages impacting operations, monitor incidents frequency and severity to reduce disruption, maintain robots control, regular audits and contingency plans to protect assets and reputations. And now we are going to see about performance merits. So what are the performance merits? So it is an profitability ratios, track ROA and ROE to measure returns and on assets to equity, compare net interest margin and cost of risk trends. So risk trends. Use trend analysis to assess earnings, sustainability and capital allocation effectiveness is an portfolio profitability ratios. So next is then liquidity ratios. So what is mean liquidity ratios? It is nothing but monitor LCR, NSFR to ensure short and medium term funding, resiliences, analyzes cash inflows, various outflows under stress scenarios, maintain diversified funding and liquid assets buffers to meet obligations. So next is efficiency ratios. So what does mean efficiency ratios? It's nothing but evaluate cost to income and operating expenses trends to gauge productivity, benchmark against peers to find improvement areas, implement process automation and cost control to enhance margins. So finally we came for the conclusion. Conclusion is synthesizes risk and performance insights to inform strategy and capital planning. Prioritize capital adequacy, liquidity, resilience and credit quality improvements. focus on efficiency gains and operational controls to support sustainable profitability and regulatory compliance. Thank you.